Welcome to the first annual Residential and Commercial Real Estate Roundtable. The Roundtable series is hosted by DoubleLine, an active investment manager with $140 billion in assets under management. This edition of the Roundtable brings together 4 thought leaders in residential and commercial real estate, debt, and real estate investment trusts. In a discussion moderated by DoubleLine's Deputy CIO, Jeffrey Sherman, our distinguished guests will analyze the fundamentals and market pricing in the universe of residential and commercial real estate, as well as the related credit and securities markets, and share their outlooks in these sectors. The housing and commercial property markets have always been characterized by their challenging heterogeneity. Both commercial real estate and housing are subject to geographic differentiation, industry differentiation, and demographic differentiation. Within commercial real estate, fundamentals vary widely by property type, such as hotel and lodging, industrial, retail, and office. Housing is an important part of American life and the economy, with over 65% of households being homeowners and housing contributing significantly to U.S. GDP. Securities backed by real estate, especially residential mortgage-backed securities, can have exposure to hundreds or thousands of loans with widely varying terms, credit underwriting, and servicing. Overlaying this complexity are the unprecedented conditions of 2020, including the impacts on loan performance by the COVID-19 pandemic, economic lockdowns, unprecedented fiscal and monetary policies, and the uncertainties over presidential and congressional elections in November. As a result, the performance in these sectors depends on bottom-up credit analysis, as well as an ability to manage through broader economic and business developments. Our Roundtable Prime guests bring this caliber of expertise to our discussion. Our moderator is Jeffrey Sherman. Jeffrey Sherman is Deputy Chief Investment Officer of DoubleLine Capital and a portfolio manager on a number of DoubleLine's fixed income and derivatives-based investment strategies. In addition, he hosts The Sherman Show, a podcast focused on investment, market, and macroeconomic themes. Chen is a portfolio manager at DoubleLine, where he heads the firm's investment team on commercial mortgage-backed securities and commercial real estate debt. He serves as a permanent member of the Fixed Income Asset Committee and Structure Products Committees at DoubleLine. He recently authored Commercial Real Estate Credit in Post-COVID-19 World, a paper available on DoubleLine.com. Shinoda chairs DoubleLine's Structured Products Committee and heads the firm's team specializing investing in non-agency residential mortgage-backed securities, whole residential loans, and other mortgage-related opportunities. He is co-author of the recent paper, Residential Market Update in the Year of the Pandemic and Economic Shock, available on DoubleLine.com. Chen and Shinoda also serve as portfolio managers on a number of DoubleLine's fixed income investment strategies. Bill Hughes is a managing director at Colony Capital, a global investment company which operates as a real estate investment trust. Bill Hughes is responsible for liquid investment strategies and is the portfolio manager for the firm's commercial real estate securities portfolio. Before joining Colony Capital in 2017, he managed a private fund at Kayne Anderson. Before that, he was a portfolio manager for an event-driven hedge fund controlled by Société Générale. Bill Hughes began his career as an investment banking analyst at Goldman Sachs & Company. Ryan Simonetti is the CEO and co-founder of Convene, the company that designs and services premium places to work and meet. Ryan Simonetti founded Convene in 2009 with the intention of disrupting the commercial real estate industry and transforming the workplace by capitalizing on converging trends in real estate, technology, and hospitality. He has expertise in real estate acquisitions, development, and structured finance. With Ryan Simonetti at the helm, Convene has raised $410 million in funding to date and operates 32 locations in the US and UK. This edition of Roundtable was recorded on September 29, 2020, and is divided into 2 segments and will appear on DoubleLine's YouTube channel. Jeffrey Sherman, Deputy Chief Investment Officer of DoubleLine Capital, will now open the first segment of this edition of Roundtable Prime.
All right, welcome to our real estate roundtable today. We're competing for airtime with the presidential debates that go on tonight, but I think this one will be very informative as well, and hopefully a little more controversial. So thanks for joining us, the 3 of you in person, as well as Ryan Simonetti, who's joining us via Zoom technology. So maybe I could give a little introduction on what each of you do, or each of you can introduce kind of who you are and what you focus on. We'll start with you, Bill. Talk about your role and what you do at Colony.
Sure. So at Colony Capital, we are both an owner-operator of real estate assets as well as an investor through private equity funds, credit funds, and public security funds. And so I manage our public security strategies across the real estate landscape.
Okay, Morris?
I'm Morris, and at DoubleLine, we currently manage commercial mortgage-backed securities as well as commercial real estate loan investments. And this it's an effort that I lead currently within DoubleLine. These are investments that goes in both credit funds as well as our public fund vehicle structures.
Okay, Ken?
I'm Ken Shinoda. I'm a portfolio manager managing the non-agency mortgage-backed securities team at DoubleLine. I'm also a portfolio manager on our variety of our bond funds, everywhere from total return bond fund to our more opportunistic hedge fund and private fund strategies.
And lastly, Ryan.
Ryan Simonetti, co-founder and CEO of Convene. Convene's we think about as a hospitality brand and a workplace experience platform that partners with both asset owners as well as progressive companies to create inspiring places to meet, to work, and to host corporate events.
Okay, thanks for that. So I think the topic on investors' minds today is the strength of the stock market. And a lot of that strength has been driven by the technology sector. And so you can see today we're using technology to not only communicate with our clients and investors, but also to bring this event together. So we think about the technological innovation and the importance of it in our society. Maybe I'll start with you, Ryan, since we're doing this digitally. How does this impact the real estate market as you think about it? What is technology's impact on real estate today?
Look, I mean, we believe that technology is going to continue to lead real estate as an industry and as an asset class into the future. The same thing that's been happening to other legacy industries like transportation and healthcare. We think that those sorts of transformative change are at play within the industry. If you look at just the growth of prop tech and the capital that's gone into, let's call it the software side of the industry, we continue to see that plays a bigger and bigger part of how assets are designed and built, how they're sold and marketed, how they're serviced and operated. And ultimately, how people think about investing in these assets. So it's had a huge impact pre-COVID. And, I think COVID is the great accelerator and the digital transformation that was probably underway that would have taken 5 to 10 years, we really believe is going to happen over the next 12, 24, 36 months. And I think that has broad implications to the industry and to each asset class. Specific to Convene and kind of future of work. I think today is a great example of what we believe that future to be, which is really hybrid. This idea of physical and digital, the idea of a HQ redefined, a growing population of the workforce that works remotely or at home, and then this kind of continuous need for third spaces like Convene. That can really kind of support the outsource needs of not just companies, but most importantly, employees that want to choose where they work, when they work, how they work. And I think our mission is really to try and create a great day at work for our clients wherever that ultimately happens.
Yeah, that's a good segue into you, Bill. I think about Colony, the owner-operator. You guys have undergone a transformation recently, kind of rebranding as Colony Digital. Can you talk a little bit about that as well, and what that looks like, and how technology is impacting the way you think about real estate investing?
Sure. I mean, I think from a very big picture standpoint, real estate has value because it provides the real assets on which commerce is conducted, or on which people get together to congregate. And if you think about the broader digitization of our economy, real estate has to adapt to provide the real assets that support that. And so as we think about how business has changed over the last several years, and that change has been accelerated through the COVID crisis, right? Increasingly, business has gone from being conducted in person, in offices, to virtually, right, through video conferences. And that means it's actually happening really in a data center and then being transmitted over fiber networks and via cell phone towers. And so the real estate market and the growth in the real estate market reflects those sort of broader secular changes, both for the good and the bad. It's been a huge driver of growth for the logistics REITs that provide e-commerce infrastructure and the cell phone towers and the data centers. And it's dramatically changed the use case for a lot of legacy real estate. And that includes office buildings and it includes retail real estate.
So Morris, when you're thinking about the commercial real estate market and trying to really try to invest in things that you think have long-term value, are you using technology to do these things? I know previously you guys spent a lot of time with teams on the road, making sure you kick the tires of the building, going in and out of these properties. How has technology changed that, and how are you seeing that impact what you do in the commercial real estate side?
Yeah, I mean, there's definitely an element of, as a real estate investor and within the commercial real estate credit side or loan side, you're always trying to figure out, what's the best way to get a data point, whether the rudimentary sort of traditional analysis, when you're looking at a building, and let's just say I'm in Los Angeles and the building is in Denver, Colorado, you would pick up a phone or you would fly there, pick up a phone and talk to a broker that knows that market very well, or you fly there and try to talk to brokers that know that very well. And as part of the betterment process over the last few years in terms of thinking about getting access to the additional alternative data, that is something that we always try to figure out. Obviously, there's a cost associated with getting that, and as a function of technology, you're starting to see geolocation sort of data being used within the financial markets in terms of mobility trends. You're starting to see alternative data sources that you can glean off of Google search trends that shows search activities within a certain sort of geolocation about travel, about hotels, and whatnot. And so these are things that technology has added to a investor's repertoire. And these are things that I would say a traditional real estate lender or commercial real estate investors, you're always trying to gather, right? We're still in the early stages. It can be expensive, but if you can bark down the right avenue, you can find it.
Yeah. And Ken, thinking about the popularization of a lot of these technological sites, I think of just searching for a home online, or things you guys have done with partnering with originators to do that. How is technology impacting the residential side when it comes to real estate?
Yeah, well, one of the long-term trends that people have been trying to do for a long time is to speed up the origination process, right? A lot of people maybe that are going to watch this own a home. 65%, actually more than 65% of Americans own homes now. And when you get a mortgage, it's like 1985 still, right? You got to get your W-2s. I guess you could send them in via PDF these days, but it still takes a long time. And people have been trying to speed up that process. And it still struggles because we're still dealing with paperwork and you got to send the paperwork. So blockchain could change that. And that's one thing, something that's in the works. Former founder of SoFi, which is now they've got their name on the football stadium here. Paid a pretty penny for that for nobody to be in that stadium. But they started a new company, Figure, and they're working on that. So that's something that's not here yet. But if we can speed up the process of buying a home, especially that origination, that typically takes the longest. You find the house, you got your broker, you put an offer in, you go into escrow, and then you're sitting around stressing about your loan. So if we can speed that loan up, that's going to change things a lot. And it's not really great for a mortgage investor, and I'm a mortgage investor, because that means faster prepayments. Just imagine one day, Alexa, refi my mortgage, right? It sounds crazy, but it's not, and it could be around the corner. The other thing is, when you buy a house, there's this kind of physical aspect of going to it, walking around the property, kind of like you talked to Morris about on the commercial side. And COVID has kind of changed that, right? Like people didn't want to let people in their homes. People didn't want to go into somebody else's home. And when March hit, we were worried that, because we buy non-performing loans where you want these homes to sell. And we were worried that all sales are going to stop, but they didn't. People found a way to transact. They started doing kind of Zoom notaries and things like that. So technology allows kind of changes, and anything that was trying to change but was taking too long, all of a sudden it's kind of forced to change now because of COVID, and technology is helping that change happen at a faster pace.
Yeah, so you bring up a good point here, COVID, right? So COVID, we've all been talking about it for 6+ months at this point. It's had a huge impact on the economy, right? We've seen that. We've seen some bounce back in the data. However, all of you, and I point to Ryan as well, operate in the center of the crisis, right? Hard hit from whether it's forbearance programs, whether it's the lack of business travel, the uncertainty about the future of office space. So maybe coming back to you again, Ryan, what do the fundamentals look like from a credit perspective? And when you're thinking about your business and your long-term viability, how are you managing through that today in this current COVID world? Because we keep calling it the post-COVID world, but we're still in COVID.
Yeah, look, I mean, one of the things that we were very cognizant early on is who are we serving from a customer perspective? And when I think about kind of shared service providers like Convene, to some extent you could think about us as aggregators of a certain credit profile based on the customers that we serve. And I think thankfully, for Convene as a premium brand, it's kind of pushed us up market where our customer base tends to be larger, enterprise. So just under 35% of our revenue comes really from kind of Fortune 1000 global companies. A fair amount of that is recurring via our workplace product, but we're even able to shift our kind of meeting and conferencing business to a more recurring model over the last few years. And then even on like what I think about is kind of the SMB and mid-market size, we've been able to, I think, attract a different type of credit profile and credit risk. So even through COVID, we haven't seen meaningful collection losses. Of course, we've had to work with some of our customers that wanted to downsize or halt memberships or cancel and reschedule meetings for later dates. But generally speaking, I think our profile of customer has held up really, really well. That's not going to be the same for, I think, a lot of the other co-working providers in particular who have been aggregating, in my opinion, probably a little bit of a different credit profile. Whether that's an individual independent consultant or a really small business that doesn't have the scale or financial wherewithal that a larger institutionally financed and backed company would. But look, we're in the business of providing office and meeting space, and as much as I'd like to stand on here and talk about how resilient the business model, which it is we're still in a cyclical business, and we're going to ride the wave over the next 24, 36, 48 months as we work our way out of this crisis, and just need to continue to do what we've done for a long time, which is create the best product in the market, create the most value for your customer, and there's a home for us out there, and it's a big TAM as the world continues to move more towards outsourcing.
Yeah, and so Ken, picking up on that too, we remember, well, I recall specifically, I know you haven't forgot it either, when the administration came out and announced, just don't make payments on your mortgages, right?
Yeah.
How has that impacted your market, and how do you think about that? How does one even start to model this when you think about the credit risk underlying that, knowing that people are just essentially squatting in a home and not making those payments?
Yeah, well, when they first came out and said that, I sat there and said, well, if that happens, the whole system's going to collapse because it's not made for nobody to make their payments. There's all sorts of servicers that need to collect and distribute them to bonds and things like that. But at the end of the day, less people kind of went for the forbearance than we had thought. I thought it'd be kind of maybe 10+%, even into the teens, based upon looking at other periods of distress. And one that everyone's sick of me talking about is hurricanes. That's kind of the game plan for forbearance. The FHFA, which governs over Fannie and Freddie, which are where most of Americans' loans go to, they have a plan that if a natural disaster happens, you call up your servicer, that's who collects your principal and interest, and you say, hey, I've got an issue. Whether it's a hurricane, this time you can say, I had a COVID-related issue, and you don't need to pay your mortgage for up to 12 months, and it doesn't hit your credit score. So this is actually a great thing for most Americans. 12 months is a long time. It allows time to pass, allows the economy to open back up. And what you found is that number actually was about 8% nationally. So it went up to 8%. It's falling now on a national level. lower credit score borrowers, maybe the number's going up. Today we saw data that lower loan balance loans, delinquencies are going up. And that really has to do with kind of the mix of people that are hurt by the economic shutdown caused by COVID. This is kind of a story of winners and losers. There's certain businesses that are thriving, like industrial and data centers and things like that, and the Amazons of the world. And then there's other businesses that are suffering, like retail and hospitality. And you can see it in the stock market. There's like 6 stocks that are up massively in the S&P, and everything else is flat to down. But what you saw is that things aren't as bad as we thought on the single family side. Housing strength has come in pretty well. Even on multifamily, when they said nobody needs to pay their mortgage, our initial reaction was, well, okay, if I'm a renter, then if the rich homeowners don't have to pay their mortgage, why do I have to pay the mortgage? I'm a renter. And people thought that the collections were going to be really bad. In April, 88% of renters paid. I mean, we were kind of shocked, right? We thought it'd be way worse. And now it's back into the low 90s, which if you look year over year, it's almost the same as 2019. Now, maybe it's because of the entitlement payments are starting to roll off now. So we'll need to wait and watch. But the consumer, I think, has surprised to the upside.
Yeah. So Morris, you don't have the hurricane experience that Ken had. I know we got tired of hearing about Puerto Rico and hurricanes and everything and all the meetings when we were struggling to try to figure out what value was back in March. But you guys don't have the same history in the commercial real estate market. So thinking about the process of either it's multifamily with it being forbearance programs or moving on to something like office space, like hotels, how do you do credit underwriting at this stage? How do you think about that and try to transition? I think my recollection from the data you've been providing us is that delinquencies are a bit higher than what we heard from Ken in the residential side.
Sure. I mean, if you just simply look at the headline, headline news surrounding commercial real estate, there's definitely a lot of negativity involved with that, and I would just chalk that up to just a lot of uncertainty. And as a reflection, you're seeing even in the commercial mortgage bond market, where bonds are backed by commercial real estate loans as a whole, or commercial real estate buildings as a whole, you're seeing delinquencies at 8%, and relative to where that was in a pre-COVID scenario, delinquencies were sub 1%, and so we did increase by 8-fold effectively within 6 months, and that goes to show that there has been a lot of distress or initial distress coming into this COVID environment. As an investor, and we're thinking about the world, one can easily shrink into this, get into this vacuum where things are ending. A lot of real estate is going to go bad. Let's just be safe. I think at DoubleLine, and as an investor as a whole, what we like to do is more so think about what's actually going to perform, what's going to underperform, what's going to outperform, because all different types of commercial assets are different. Ken had touched upon the residential component of within the commercial real estate market, which is apartment buildings. Those have outperformed relative to expectations, and a lot of that had to do with the fact that from a U.S. consumer perspective, you had fiscal stimulus that supported a lot of the U.S. consumer base, at least for now. You also have the availability of commercial real estate loans, and in terms of the lending market that's open from the GSEs, so government sponsored entities such as Fannie and Freddie. And so those are have been very, very helpful to prop up multifamily markets, and that's the notion that for us, we feel that if you can choose the right property, look at the right deal, you're definitely going to be able to, as an investor, think through logically if this is building good or is this bad, and that's just one example.
I think what he said, one of the important things you mentioned, is what makes this really different from the global financial crisis is that the lending markets, and B, the securitization markets came back way quicker. I mean, what really caused real estate to suffer is, how am I supposed to buy real estate when I can't get a loan? Everybody buys stuff with a loan, right? And so we can thank Jay Powell for that, helped create liquidity in the marketplace. They created another one of these TARP programs, right, or TALF, and we didn't even really need to use it. I mean, and the securitization markets came back in months, whereas it took years in some cases, And that's really helped, I think, the real estate market and the housing market, is the fact that you can go out and you can get a loan. I mean, we can sit here and say, was it the right thing to do? Should they have created the bailout? Okay, we can spend hours talking about that, but it has helped. It's created liquidity, and it's helped kind of the market at least function on that front.
And even in the private markets, right? Companies like us were able to access the credit markets and the equity markets privately, where back in 2008, 2009, you just didn't have that access to liquidity even in the private capital market. So I think the fact that there's just so much more liquidity available today, and obviously, the Fed took such decisive action quickly, that that's helping support really, I think, all of us, especially companies like Convene that are kind of ground zero for impact of this crisis.
Yeah, you mentioned that, and private equity gets a bad name when it comes to commercial real estate, right? So maybe, Bill, you can pick up on this. You think about REITs too, and just thinking about the private markets as well. What is the footprint of private equity within that space? And I'll bring this over to you as well, Morris, when you're done. But as you think about the dependency on private equity, there's been a lot of money raised, need to be put to work. I think to Ryan's point there, we did have it sitting on the sidelines. What was your experience during this tumultuous time?
I think it's to be determined, right? Because in the real estate market, one of the interesting features is that private funds, the private fund landscape is significantly larger than, let's just say, the public market, the REIT market. It's multiples bigger. And there's, I think, a lot of hope that there's an exit for some of the public guys who seem to have real secular challenges by way of these private funds. But I don't think it's going to actually play out that way. I think what's interesting is, if you look at the way that capital is allocated in existing private funds, these guys have a ton of money in office, they've got a ton of money in retail, and as there's fresh capital for those types of funds to redeploy, they are not going to put it into those types of assets. It means they need to find places different from that, places that are not secularly challenged. So industrial's got a massive bid from the private fund structures. You're going to see that in single family homes for rent, which is sort of a new alternative asset class within real estate that doesn't have these sort of secular challenges. And so for REITs, a lot of people, I think, have been attracted in the short term to the concept of, wow, there's some real value in some of these secularly challenged subsectors, right? That they're trading at huge discounts to private market value. I think that those discounts are going to close, but they're not going to close in the way that people hope, right? I think that private markets are going to converge to the discount rates and to the valuations that the public market has reset to. And I think there's been a real diminution in value for office buildings and for retail real estate, and there's probably more to come, particularly on the retail side. And on the other side of the coin, there's been real growth in other sectors of the market. So in e-commerce, for example, you had effectively 10 years worth of e-commerce growth from a market share perspective in 3 months. And as a consequence, the bid for the industrial properties that provide the infrastructure to support that e-commerce, the outlook for that group is really, really robust. And it helps that they already had a pretty good business model where you had a lot of supply constraints coupled with secular demand, and that secular demand growth has accelerated. So there's winners and losers in the real estate space, which make it, I think, super interesting right now.
Yeah, it sounds like that makes it a challenge if you're an equity investor there, but as a debt investor, it sounds pretty positive to me, right? Morris, what are you seeing in the industrial sector as well?
Yeah, I mean, I think as a debt investor, you're definitely constructive on certain areas, and industrial is one aspect where you can think through logically. Even as a debt investor, you keep in mind, as a debt investor, you have protection from the borrower's equity. As you think about losses. As a debt investor, we're also capped in terms of the returns that we get. And so, that's important to know, that we don't want to get into a loan where you're going to lose money, especially when you're funding that loan. And industrial is unique in the sense that, if you look at e-commerce trends, if you look at the whole the notion of last mile logistics, and even as a consumer myself, you can walk around town and see the shifting trends in terms of retail. I'll use Nordstrom by way of example. They have in my neighborhood a small storefront, which is essentially for alterations, for package returns, and for any sort of ancillary services outside of just selling a product. They're not selling any product. It's just an outpost that allows you, without as a resident, without having to drive to a mall or without having to drive to a physical location where Nordstrom is, to actually return products, to do what you need to do as a consumer. That's important, and there's this notion of the shifting trends in terms of retail. You're starting to see alternative uses in terms of brick and mortar. It doesn't have to sell a product; it just be a physical presence where you're providing these services. But more importantly, what this means is, an outpost that's not selling product, you're actually, providing delivery. Well, the product needs to come from somewhere. And if you live in Los Angeles, there's only a finite amount of space where you can have large distribution centers. And so a lot of online platforms are utilizing these locations in a meaningful way. And that allows us to, I kind of just walked everyone through what my logical thinking is for the viability of an industrial product. And that's what makes us feel comfortable about it, right? There's other areas. Right now, another hot topic away from industrial is biomedical research space. And in that sort of space, at least in the debt markets, you're seeing industrial paper and bonds backed by industrial properties and bonds backed by biomedical science sort of research labs trade in terms of pricing. They're equal. They're equal weights. And so if you think about the properties that are located in Boston, within Cambridge, near all the research centers in itself, those buildings, those life science buildings, are also, at least from a near-term perspective, there's less of a dislocation as we're seeing in elsewhere in terms of commercial. But these are examples of trends that we're seeing, and definitely easy to, it's I wouldn't say easy, but there's areas that we're constructive in. That's how we think about things.
Ryan, you'd mentioned too that there was the ability to go to the markets and access it, and I think Ken thanked Mr. Powell for his work there. We recall that the last crisis was centered around real estate, and so talking to a lot of investors back in March and April, panicked investors nonetheless said, here we go again. Once again, we didn't learn our lessons, but you seem to think it's a lot different. Can you tell me why you think that it's a different approach today from what we saw, let's say from 06 to 08, and then we'll get Ken's view from the single family side?
Look, I mean, I was in the lending and investing business, kind of during 2006, 2008. Ended up running a workout and restructuring group in 2008 and 2009 before I started Convene. And I'd say the big difference, to me throughout even this last cycle, has been leverage levels, like true underlying leverage. And I do believe that the credit markets, generally speaking, and this is not just banks, but even on the private side, maintained, I think, better discipline for longer. And I think a lot of the structured stuff that folks like us were able to do in 06 and 07 and leverage the bond markets via CDOs and other kind of synthetic instruments, you didn't have that same access, I think, to some of these more long-term kind of creative financing structures. And I think that that's helped this crisis. I also believe that for those of us that were there in 08 and 09, I think we learned a lot about restructuring. And I think generally speaking, lenders are more patient today. The idea of immediately going to default and getting into a complex workout, I think most of us realize that if we just had time, things tended to work out pretty well. And I do think that just the general nature of how the lender-borrower relationship is approached on the commercial side is much more partnership-oriented as opposed to confrontational, which honestly, I think that was more the mindset, in some of the crises they had in 80s and 90s.
Ken?
Yeah, well, it's the leverage in the system that basically created more aggregate demand for assets, which allowed underwriting criteria to deteriorate through time, right? So it's like the fact that you have the CDOs buying the CDOs that bought the securities that were packaged up, and there's just infinite demand for all those assets, created the ability to create loans that people would buy, and the loans kept getting worse and worse and worse until they were no money down, no doc, right? Just, you know, call up your countrywide broker.
And that was commercial. I mean, we were doing 90%, LTC. I mean, that didn't exist this whole cycle. At least I haven't seen that sort of stuff.
So when that happens, I can buy assets with no money down. Home ownership rates went from 65% long-term average up to 69, almost 70%. So basically, people that shouldn't have owned homes, right? You should have to have money to put money down. If you have money down and you have equity, you're less probable to walk away. And so if you look at history, look, everyone that goes in delinquency doesn't ultimately default. In 07, 06, kind of vintage collateral, Fannie Freddie, we're just looking at the data this week, delinquencies got up into like the mid to high teens, but ultimately only about 9% of them defaulted. And of the 9%, they lost about half the money when they sold their house. That's because home prices went down 35% nationally, 50% in some places like Florida and Riverside. This time around, you didn't have that excessive lending, and so you don't have this crazy home ownership. You actually don't have homes. There's not enough homes, right? Existing inventory of homes going into March was the lowest it's ever been. It's like a 35-year low in inventory of homes. So to take prices down to cause this kind of capitulation of prices collapsing, you really need that supply to flood the market. And on the residential side, there is no supply, and we haven't really been building that much either. So that's really helped home prices be buoyed, along with the fact that the banks aren't going under, Fannie Freddie aren't going under, the lending came back like we talked about. So the system of the financing is still there. In fact, rates are lower by over 100 basis points. And people actually need homes. The joke in 06, 07 was default on your mortgage, you need your car because you need your car to drive to work. Well, now you can't go to work. You got to work from home. So everyone's kind of, hiding out in their house these days. And so at first we thought, okay, maybe you don't need your house, you don't need your car, but you need your home. Turns out you need your car too, because if you have to go somewhere, you don't want to take the subway anymore. So used car prices, amazingly, I know we're not here to talk about used car prices, but this is kind of one of those COVID-related things. Like, you never thought that used car prices would spike in this economic recession, with unemployment skyrocketing, but used car prices are skyrocketing. So there's all these unintended consequences that as time passes, we kind of see happening out there.
Yeah, I think of all the people sitting there, you look closest to the used car salesman with your colorful jacket.
Yeah, you like it, right?
No, yeah, I do. I love it. So again, trying to interject a little humor as we talk about this. But Bill, you'd mentioned too these single-family rentals. I hear Ken talking about the supply and everything. Is some of the reason of the lack of supply is that institutional buyers are buying these up? Like, what does the market for single-family rentals look like today? And what do you think about its impact on residential real estate today?
So it's a somewhat new asset class as sort of a public company structure. We've seen it evolve over the last 5 to 10 years. And it's basically something that was born of the last crisis, right? At the end of the last crisis, there were all sorts of homes in default, and you had institutional investors go out and buy tens of thousands of homes and bring it together into a single company structure where you were managing it and trying to wring out economies of scale by way of
But they also
owning.
had the wrong name on it. It was always called fix to flip or something, but it was called rent to own. Sorry, it's called rent to own, but you're actually owning to rent. I always call it backwards, anyway.
Well, anyway, owning to rent, but what they found was that, it was actually a lot trickier to do. Like, these economies of scale were a little harder to extract, and no one had ever tried to do this as a real business at scale. And it has taken some time for these companies to sort of figure it out, and they've changed their models. And really what they're finding is the way to make the most money on a sort of per unit basis are homes that they designed, built themselves for the purpose of renting. And these are houses that have, wider staircases and are easier to move in and move out of and are more energy efficient and so forth. But the point is, it's become a real business over time. And then it's one where, in the context of this crisis, as the marginal dollar has found the attractiveness of a house and not an apartment, and sort of having more space and moving out of crowded cities, they've had a real short-term uptick in demand, and that's sort of reflected in the stock prices of some of these businesses relative to apartments.
The big thing now is build to rent. So there's not enough homes to buy, right? In the crisis, there's all these foreclosures. They could come into a neighborhood in Vegas and buy like, half the houses on the street. And so it's like you said, it's an economies of scale business. I was skeptical when they first started, because I said, how are they got to just keep scaling and scaling and scaling? Like, if you do this in a small format, you're just not going to have, you're going to be paying too much for every marginal improvement, right? And like just fixing the properties. The nice thing about multifamily is it's got 4 walls and all the units are inside. So you don't have to deal with, 4 walls on every single unit.
Right,
because
there's
costs just start skyrocketing.
There's no economy of scales on the number of roofs and the number of hot water heaters and all this other stuff that you need. But over time, you've got a lot of smart guys who've focused on how to manage this business, and they've figured out how to do it. And the idea has proven out probably 5 to 10 years later than they thought it would. But it's turning into a real and attractive business, and now it's its own legit subsector within the REIT space.
And it seems like the Americans, I mean, I know it's like, the American dream, own a home. People are getting more comfortable with renting and wanting to rent and wanting the flexibility. And to the extent they can build nicer homes to rent, like this seems like the units that they want to build, they seem to be on the margin maybe slightly nicer than what they already own. And so there's an attraction to that. So it does seem like a growing business, and it's still such a small fraction of the percentage of homes that are purchased to rent out. It's still pretty small, right?
Now, is the exit strategy on this, because I recall back when we were seeing these pitches and people talking about this, and I think it was around 2010, 2011, that a lot of it was, okay, we're going to rent this out for a little bit, wait for the market to strengthen back, have a recovery, and have an exit strategy. Is that still the same today, or is this long-term actually building for the intent to rent these out? And I'm thinking about that in the kind of context as Ryan's talking about it's really a cohabitation, right? You're saying we're going to build this for society, have people move in, and we're going to share this throughout the cycles. Is that the way you're viewing it, or is it still kind of that private equity model, get cheap, get cash flow, exit strategy?
Yeah, I think originally the idea was we're going to buy all these homes and we think we can turn it into a business, but if not, the value of the homes that we're buying at these auctions is going to go up. And so we have a couple different ways to win. And I think now home price appreciation isn't a big part of the thesis, but it's that this is a business that can generate acceptable returns on capital.
So Morris, as you're thinking about this in the context of multifamily, so Ken's talking about marginally better quality asset here. How does this influence your thinking? I know you guys share a lot of ideas across our real estate teams. How are you thinking about multifamily in this context?
Yeah, I mean, I think there's going to be, again, Ken used the word, winners and losers in the beginning in terms of this COVID landscape. And I would say that there's going to be winners and losers within the multifamily arena as well, despite the fact that us being constructive about multifamily. And a lot of that has to do with the fact that I saw a statistic this morning. If 2% of the urban population migrate out of the urban centers into suburban areas within the United States, there would then be a requirement of about 500,000 homes to the extent that they want to move into a house. Either it needs to be built or by a home builder or by a single family rental business sort of owner operator.
So just a pure shortage
just
of
a
supply.
pure shortage of single family homes to the extent that 2% of the urban population decides to move, right? And today you can say that's probably realistic. From a probability standpoint, that could happen. And we're definitely seeing that sort of migration trend from urban centers to suburban arena in terms of thinking about individuals wanting more space, just given that the urban centers are all shut down. I mean, walking around downtown LA, it's very, I would say it's somewhat of a ghost town relative to, in months past when, during the daytime when, businesses were actually open. So there is that sort of short-term initial demand. Whether it sticks in terms of long-term wise, yet to be determined. But for us, if we think about multifamily, the losers, I would say in the interim, I wouldn't say, when we say losers is somewhat of a strong word, you're going to see some financial strain on existing rental rates. And downtown LA is a prime example.
Especially like high-end urban.
High-end urban, yeah, you're definitely seeing that in New York City as well. I mean, someone was quoting a 14-month lease, 3 months free rent, right? That's close to 30% discount if you want to think about it on an annualized basis in terms of what your rental rate is, and that's in Manhattan. Would not surprise me if in downtown LA you're definitely seeing that as well. So that's the near-term sort of viewpoint and strain you're going to be seeing as a whole, coming out of this this COVID effect. So for us, the constructiveness is multifamily that's outside of New York City, outside of San Francisco. If you just think about these urban centers as a whole, just people wanting more space.
Yeah, on that point, Ryan, you and I were discussing things earlier, and you mentioned you don't think of it as urban versus suburban, but really, I forget the phrase you used, but just that mobility and moving around the country. Maybe you could share some light of how you're thinking about that in this kind of post-COVID world.
Yeah, I call it the rise of the rest.
Okay, that's the phrase.
And this was a trend that we saw happening, pre-COVID. One of our investors is Revolution Growth, which was Steve Case's fund, and he's got this whole rise of the rest campaign that he's been running primarily around venture capital, starting to go into these second and third tier cities to support entrepreneurs there. But to me, that's playing on this bigger trend of kind of second wave urbanization. And what we've seen, especially from our larger corporates, both in, let's call it New York, Chicago, even what we're hearing and seeing out of San Francisco and Seattle with the big tech companies, is these, what we would have thought historically as second tier cities. What's happened in Austin, what's happening in Salt Lake, what's happened in Seattle to some extent off the back of Amazon, Miami, Tampa. And I think these urban environments that have a real sense of place and culture, because what's not going to change is that we're in an experience economy. And I do think that people, regardless of where they choose to live or to work, they want to have access to those type of work, live, play experiences, not that far from where they are. And I think that these kind of second tier markets are really, really well poised, not just in the short term, but the medium to long term. University towns that have a real sense of place and purpose and culture become really interesting retirement destinations. And so I do think that there's a lot of stuff that's going to happen that to me is, I wouldn't make an urban versus suburban bet medium to long term, but I would go long in some of these other cities. And that's part of our growth strategy now. I think we got a little bit spoiled, opening up lots of successful locations in New York, and probably got a little bit overly weighted concentration risk wise to New York, where our thinking now is to really kind of broaden the network and put flagship locations in what I think are kind of these growth cities and growth markets, where it's not just about COVID. There's a lot of other underlying issues in cities like San Francisco and LA and Chicago and New York, affordability, access to education and healthcare and all these sorts of things. I think they're going to push people into some of these other markets where, I can own a house, live 15 minutes outside the city, have a big backyard. What would it cost me $2.5 million in Westchester, I can get for $600,000 outside in Nashville. And in 15 minutes, I'm at my office downtown and I don't have to get on a subway or a train.
I don't know if it's 15 minutes.
But 30 minutes, whatever it ends up.
Traffic's pretty bad. Yeah, no, I get what you're saying. But this theme had already started. I mean, this has been going on for, I would say, kind of like almost the last decade. And Morris and I spent a lot of time traveling, raising some money together for some of our funds. And that was kind of the big theme for where we wanted to lend was not, we didn't want to lend in like New York and LA because it was expensive, right? You're lending money to the colonies of the world at a really low rate. But if you go to these growth cities, whatever you want to call them, there's a big demographic story. And it was already happening pre-COVID, and maybe this is just speeding things up, but as people realize and companies realize, I don't need to have everybody jammed into an office tower in Manhattan. Maybe I can have the back office in Nashville. Maybe I can have, different departments in different parts of the U.S. And these university cities. Columbus, Ohio was like the fastest growing city ahead of Austin, surprisingly. Columbus, Ohio. I mean, I guess they got Ohio State, but it's a theme that has been going on. And those areas, that not only does the commercial real estate benefit, the residential real estate benefits as well. I mean, some of the locals don't like it, in fact, right? I mean, think about if you lived in Austin like 20 years ago, there was no traffic, you could drive like quickly to go get your Franklin's barbecue. And now, have you been to Austin at rush hour?
Oh, forget it.
It's a nightmare.
The infrastructure is horrendous. Yeah. So I think I want to pause here because I promised everyone it would be more engaging than the debate tonight. So far it has been. I want to take a break. We can cut this episode off. We're going to pick this up, and I want to transition into preferences, because that's something you mentioned, Ryan, how behaviors change. So I want to talk about the behavioral aspects of real estate and what we're seeing in the future.